Okay, in this video we're going to be walking through bonds being issued at a premium where we're going to amortize the premium using the straight line method. So kind of building off that basic scenario where the bonds were issued at 100 and we're saying, okay, what if they were issued at 102 instead of 100? So what does this imply about the bonds? First of all, it implies that the bond price is above the par value. It was issued at 102% of the par value, which means it is being issued at a premium. The bond rate, therefore, must be above the bond yield. But again, because we're using the straight line method, we don't actually have to solve for the bond yield. So the firm has now recorded the interest payment, which of course is accredited cash, and they also have to amortize the premium on the bonds payable, and that's going to be a debit to the premium. So the interest expense is going to be derived from the cash payment and from the amortization of the premium. And so since we're using the straight line method to amortize the premium, and since the interest payment is fixed, it means that the interest expense is going to be the same in each period of the bond's life. All right, so going to our example, again, the basic information is the same. The only thing that has changed is the issue price is now 102. And so we're just going to kind of walk through each piece of it. Again, the issue price is 102%, which means that the issue price is $153,000. And so looking at that initial journal entry, we can see that the cash received is $153,000. The par value of the bond is $150,000, and the difference goes into the premium on bonds payable account. And so each interest payment is the same as it was before. We take the bond rate, multiply it by the par value, multiply it by 1/2 because it is semi-annual payments. And so the payment each payment is $5,250. We're amortizing the bond premium. The bond premium balance is $3,000. We amortize it over the 10-year period, but of course it's a semi-annual payment, and so there are 20 periods for the amortization, which would be $150 per period. And so the journal entry, to be theoretically sound, we take the cash payment, we also take the amortization of the bond premium, and from that we derive the interest expense of $5,100. We have the exact same payment on 12/31/2020. Again, the interest expense is derived from the cash payment and the amortization of the bond premium.